Hi everyone, a very warm welcome to our YouTube channel. Welcome back to yet another educational video. And today we are going to talk about short strangles. What are short strangles? How to adjust them? When to get out of a short strangle? And why short strangle this particular week is because last entire week the market has remained range bound. People who deployed short strangles were rewarded very well. So that's the reason we thought this would be the appropriate time to bring up this particular topic. So without wasting any time, let's get started. What are short strangles? First, we will understand that the first word itself is short, which clearly means it is a strategy meant for the sellers. So what is a short strangle? It is selling two OTM options, which involves one call option as well as one put option to create a profit zone. And this strategy is basically a neutral option strategy, which is usually used when you expect a range bound market, or as we call it as a sideways market. Now for the illustration purpose, what I have done, I have logged into an Opstra account. One can use this Opstra feature for one or two strategies for free. So I'm just clicking on the short strangle and I will select Bank Nifty as my instrument, and I have to click here as options. See Bank Nifty short strangle. For now I'm just selecting this. I'm just going with the 19th June expiry and I'm selecting only one lot. So here you can see put premium is somewhere around 26. So if you want, you can go and check the option chain as well from here. Before even initiating any strategy, first let's go and have a look at the charts. Let me go to the daily time frame. So what I can clearly see here, that there is a stiff resistance around 51,250 and somewhere at this zone at 49,000 there is a strong buyer. If this is the range that I'm expecting market to play out for the next 2 days, because today we have holiday, which is a Monday. So Monday is a holiday. So we have only 2 trading days for the expiry. I'm assuming, let's say market would be within this particular range of 49,000 on the downside and 51,300 on the upside. So what I'll try to do, let me go and check 49,000. 49,000 is trading somewhere for 26 and 51,300 would be somewhere in the range of 18. So what I'll do, I'll just simply change this to 51,300 and there's no premium. So let's stick to, so I have chosen these two strikes of 49,000 put and 5,900 call. And for 49,000 put, I'll be getting, as a seller, I'll be getting 26 rupees to pocket in, and as a 5,900 call, I'll be getting to pocket in 22 rupees. So effectively my total premiums is nothing but just the addition of these two. So the total premium of these two works out to be roughly 50 rupees. In this case, now remember in this particular example, I would wanted to take a call of 51,300. However, I'm forced to take 5,900 as there are not much premiums left on the call side now. So this is almost an equal strangle wherein the call and the put rates are almost equivalent. So now this is my break-even point. So if you can check this one, this is the break-even point, which means till the market doesn't breach 48,950, I will not have any loss in this particular strategy on the lower side. And till the time market doesn't go above 5950, till that time I will not have any losses. So this is the range that I would want market to remain in for the next 2 days if I want to make this kind of a profit per lot. Okay, so this is roughly max profit is 0.75% per lot, and this is only for the next 2 days. Today I'm shooting this particular video on Monday, wherein we have a holiday due to Bakri Eid. Tomorrow, of course, the premiums are going to open with some sort of a decay, so you won't get the same premiums. But the idea is not to replicate this one exactly over there. The idea is to understand this concept. So that's the reason I'm utilizing this particular option chain. So now let's understand how it works. Now, if I have sold this particular 49,000 and 5,900 while the market is at 49,981, which is roughly around 50k. When the market is at 50k, I'm roughly selling 1,000 points away put and 1,000 points away call on either sides, and then I'm trying to make money out of it. So my view is market is going to be within this 2,000 point range from 49k to 51k, and that's where I'm going to profit in. Now let's assume tomorrow if market opens, I'll go back to the charts again. So now let's assume tomorrow the market opens and tries to go up sharply and closes somewhere around 5750. Obviously you'll be having losses on that call leg. What needs to be done in that kind of a case, in that kind of a scenario? First of all, even for deploying this kind of a strategy, you have to understand, you have to have very good knowledge of technicals. Secondly, you also need to know what are your break-even points. I'm not talking about the break-even points of the Opstra strategy. I'm talking about the break-even points on the charts. Like for example, last week when we started off, if this was the lower range and this was the upper range, because remember this was the Monday candle, so then you would have played this particular triangles unless this high gets taken out, which is 5300, and unless this level gets taken out, which is around 48,900 to 49,000. Now remember, if I am deploying this particular triangle on Friday, let's assume I have deployed this particular triangle on a Friday. Now again, my break-even points on the upside would be this level. Why this level? Because market has been staying within this particular range for quite some time. So the moment it is going to break this particular range, I know for sure there will be a trending up move if it breaks on the upside. Similarly, if it breaks on the lower side, there will be some sort of a trending down move till 48,900 or 49,000. That's what my expectations are right now. So let's assume I'm expecting, so this is my first reaction level. Okay, this is my first reaction level. So let's assume the market stays here only on Tuesday, so I'll be getting the money easily. So then all I have to do, I have to book it out and then wait for market to trend, and then bet this kind of a position again. So let's say if market tries to break this 250 on Tuesday morning, the moment that happens, I am going to close that particular calls. Now why? Because my upper break even on the charts were 5250, and I know for a fact that this level has been tested quite some time. Can you see this? Can you see this particular range that the market has been playing for quite some time? So I know for a fact this level has been tested numerous times. So the moment market tries to break this, and this range is 600 points, so I'll be expecting at least 600 point trending move on the upside if it breaks on the upside. So I don't want to be in a position where my call sell leg will give me drastic loss, because market has remained sideways for the past 5 days. So I can't take any chances on that side. In that case, what I will try to do, I will book out my calls completely and I'll try to go directional. So this is from triangle to directional. I'll go. What I'll do, I'll book the loss in 5,900 call option, and I'll book the profits in 49,000 put option, and then I'll roll up my put options even more, because I'm expecting a breakout, and then I'll be expecting market to trend on the upside. Now let's assume someone has a break even point of this level. That person is ready to see whatever the MTM losses are until this level is taken out, which is the all-time high of 51,133, which we had seen on the very next day of the exit polls. So for that person, and let's assume his lower break even remains the same as this one, 46,000, as 49,000, 48,800 or 49,000. So let's assume for someone their break evens are defined as, now let's assume for someone else their break even point is defined as 49,000 or 48,900 on the lower side and 51,133 on the upper side, and that person wishes to sell 51,500 call along with 48,500. Obviously the premiums are very low, so just don't go with the premiums right now. You will actually see this will just generate only 0.26 because the premiums are ultra low. But just for the sake of this example, I'm trying to explain this particular concept. Let's assume the person is expecting market not to take this level or this level and wants to safeguard his, so this is his SL level or the break even level on the chart side. So the moment this level is taken out, he will exit from the calls, he or she will exit from the call leg totally, or the moment this level is breached, he or she will exit from the puts leg entirely. So this is their predefined level, so they don't have to get out of this particular triangle unless market takes either of this level. Now let's assume for the next 2 days market actually tries to go up a bit, and then from 51,000 again tries to come down and does some sort of a sideways consolidation. The person will get to keep this entire money with himself, because look at the break even range, it is 48,484 to 51,500. So that person will get to keep the entire triangle money with themselves. Another example which I would want to, so if this is not much of a useful example because looking at the premiums, what we can do, let's go on the some other expiry. I'll go for like monthly expiry. This one is the 19th June. Let's go for 26th June. I'll just modify this and 51,500. Let's go for, so now let's assume my view is market is not going to break until market is not going to break this level of 51,133 or 48,900 on the lower side. I would like to remain in triangles for the next 2 weeks, which is the June monthly expiry. What I can do, I can simply pick those strikes. So what I'm doing, I'm simply picking those strikes. Can you see this here? 51,500 call and 48,500 put, and I'm trying to pocket in 82 plus 52 rupees, which translates to 134. Now look at my break even. It works out to be 48,366 on the downside and 51,634 on the upside. Till that level is not to taken out, I can simply hold my positions. And what I'll try to get is the theta decay. Now remember, theta decay will play out maximum for the current expiry, and the upcoming expiry, which is the case in this particular the example, is 26 June. So maximum decay you will be able to see in the next week itself. So this is where I will try to get some money. Now let's assume if I deploy this kind of a strategy and the underlying prices tries to go up a bit. So let's assume the spot tries to go up. I'm taking the example of going up only because the market structure is overall bullish, and the vice versa will also play similarly. So now let's say this particular option tries to go up a bit. So obviously what I can clearly see here, that can you see this particular blue dotted line? Blue dotted line is the day-to-day variation that we are going to get to see. The green and the flat line is only and only on the day of expiry, when the options will expire worthless at 0,0. Till then your payoff graph would be mimicking this particular blue line. So let's assume market touches somewhere around 50,000 zone, 5,900 zones. The moment that happens, I'll be sitting at a loss of 2,083 rupees. Why? Because my calls would have definitely spiked till then, by then. So in this kind of a situation, there can be two things that you do. First of all, keep this particular rectangle as your first line of adjustment level, which means the moment 50 to 50 is taken out, I will start adjusting on my positions already. So the idea is you should never be in a situation where you are almost in the near death positions, and that's where you plan to adjust your positions. You have to start adjusting before the accident occurs. So the moment 50 to 50 gets taken out, by then I'll get some sort of a decay on my put leg. So what I will do, I will roughly book this particular put. Let's say I am booking this particular put at 55. Let's assume I have booked this particular option from 82 to 55. And then what I will do, I will try to sell a put option of 49,000, and I'll try to sell a put option of 48,800. Obviously that won't be at 118 at that point of time. That again would be somewhere in the range of 80 or 75. Okay. And then that's how I will try to manage that particular position. And let's assume if nothing happens, then you get to keep both of the options. But let's say you have adjusted here, you have booked here your 48,000 positions and come here and have arrived at 48,800, and you are sitting in the same call and you are trying to manage your options that way. Now let's say the finally the candle comes somewhere around this level, wherein you are now forced to exit your 51,500 calls totally. Then you have to book the loss and then start playing directional. That's how we will play. By now, if you are still hooked to this particular video, I would like to request you to hit the like button and click on the subscribe button if you haven't done so far. Let's go ahead. So far we have adjusted when to initiate a triangle, when you have a sideways view, and when to adjust them and when to exit them totally. Now let's understand what are the types of short triangle. One is an equal premium triangle that we just checked. The other one is a skewed triangle, wherein one can take a bullish bias triangle or a bearish bias triangle basis what the technicals look like. Now I have my view is overall sideways but mildly bullish. Then in that case, what I will do, I will try to sell maybe 48,700 put along with 51,600 call. Just have to click here, reset here, and again we'll go to short triangle. And this time what I'll do, 26 June, I'll try to sell 48,700 put along with 51,600 call. Why? Because the overall view is sideways to mildly bullish. Again, one lot, so I'm roughly selling a double of what the calls are, more than double the premiums of call. So 46 rupees call option along with 102. Why? Because my view is still sideways, but I'm expecting some sort of an breakout or an up move here. So what will happen, if my view goes right, this particular decay in the put legs will occur faster, and that will give me good money. So this is how you basically make this kind of a skewed triangle. Let's say the view would have been sideways to mildly negative, then I would have sold a higher call option as compared to the put option. So this is what your skewed triangles look like. If it is biased on the call side, if it's biased on the upside, then you will sell a higher put. If it is biased on the downside, then you will sell a higher call. Now, this is what we were talking about, how to manage a short triangle. Now, in the earlier example, we were trying to roll the winning leg. What do you mean by rolling the winning leg? I'll just mark it here. Now, what is the winning leg? Now, this particular lines, this blue lines are basically the call. This is the put option that I have sold, and this is the call option I have sold. Okay. Now, let's assume market is giving a breakout above 52.50. Definitely, this particular option would have given me money by then. So, what I'm doing, I'm booking this out. So, this is my winning leg. Why this is a winning leg? Because this particular leg is giving me profit because market went up, so my puts are in profit. So if that happens, then what I will do, I'll book out this particular option and I'll roll it upwards. So I'm rolling up the winning leg, which means I'm booking out 48,500 and I'm moving to 48,800. So I'm booking out my profitable leg. One is what we discussed, from booking out from 48,500 and moving to 48,800 because 48,500 was already in profit. Remember that example where we initiated this particular put option at 82 and booked out somewhere around 66. Now booking out the losing leg and moving further away. So this is what we have to discuss now. Look at this one. Now let's assume I have sold these particular options, and the moment this particular breakout happens, let's assume the calls and the spikes are too much. The moment this particular breakout happens above 52.50, there is a significant spike on the call leg. So let's go back to our earlier example where we have sold these two options, 51,500 and 48,500. So let's assume this particular 52 straight away spikes to 100. The moment after a breakout and when the market starts to move up, or if it makes with a very big candle, it suddenly spikes up to 100. And 100, why 100? Because it's roughly double of the sold option, right? The moment that happens, what I will do, I will book out this 100 rupee option. So I will book out a loss of 50 rupees and then I will go and further sell a 50 rupee call option, which I will get at least 500 points away from 51,500. So roughly I will be selling 52,000 call option at 50 rupees after booking a loss of 50 rupees in 51,500. We are just booking out the losing leg and moving further away. Why this is a losing leg? Because we sold it at 52 and current market price is around 104. That's why we are booking it out. The option has hit its SL off twice and the option has spiked to 2x of its premium. That's the reason we're booking out the loss and moving further away. Now, why we are moving further away? Because remember what market did. Market gave a breakout here and it is trying to go up. It has not reached this SL of 51,133 yet. That's the reason we are booking out that call option and moving further away. Now, hold on to this particular thought for a while and we will go forward. The third point is booking out the losing leg entirely. Now, let's assume after this particular breakout, when the call spiked, what I did, I exited my 51,500 call totally by taking a loss of 50 rupees and then moved to 52,000 call. Now, this is the break even of my Bank Nifty as per the charts, break even levels for me. Now, let's say market breaks this level of 51,130 or 51,150 for that matter. The moment that happens, I will completely book out my calls with the loss, with totally loss, and then I'll move to directional. Now, why? Because there are no known resistances and then it's a clear cut move that the market is going to make new highs. And I don't want to get trapped when there is no known resistance as such. So that's when I will take the decision to book out the losing leg totally. Similarly, on the downside, let's assume 49,000 is my break even on the downside. Now, let's assume market tries to come down a bit. It breaks this particular low of 49,600 and my puts spike up immediately. The 82 rupees put that I have sold, it suddenly spikes up to 164. The moment that happens, when the market is here, I will book out this particular put leg in the loss and I'll try to move back even beyond. So I'll move from 48,500 to probably 47,800 because puts would have spiked by then. So I would get 47,800 around 80 rupees. So I will try to go and sell this particular option. The moment 49,000 is breached totally, then my analysis only goes wrong. Because when I had initiated, my initial view was market will remain within the range of 48,900 till 51,150. The moment that gets taken out, which means my view only gets invalid now because market is no more within this particular range. So now I have to do something different because while initiation, I had expected market to move within this range. When the moment market breaches this particular range, I have to get out completely from my puts. Then I will go directional where I have to sell calls now. So that's where you have to changing your views. Three things that what we have written here. First is the rolling the winning leg and booking out the losing leg when there is a 2x, when 2x gets hit and moving further away. Only and only when at the initiation, whatever the break-even levels that you have decided as per the charts is not taken out, only till then you can move further away. The moment that level gets breached, you have to book out the losing leg entirely, and you have to reevaluate what the market is doing, whether you have to go totally directional or if there is some different change. Now let's quickly understand the advantages and disadvantages of a short strangle. The advantages are better yields in a range bound market. Now remember, the keyword here is a range bound market. Now this same advantage will become a disadvantage if the market becomes trending, will lead to huge losses if not exited during the trending markets. The advantage in short strangle is only and only if the market remains within a range bound. Range bound basically means it should remain within this particular rectangle. Only then you can safely assume it's a strangle. The moment it goes trending, if there is a breakout, then that is the worst time to deploy a strangle. Remember that. Sellers potentially get both call and put side premiums. That's the reason most of the sellers prefer to use this particular strategy, because they are non-directional traders by nature, or they want delta neutral strategies. They will try to sell this kind of an option. It's a neutral strategy. And the disadvantage is, let's say if there is a sudden IV spike, let's say there is some sudden announcement from the government or ministry, or something suddenly happens in the world markets or the global markets, remember there will be an IV spike. Now IV impacts equally on both calls and puts. So the moment there is a spike in the IV, both calls and put premiums will inflate. So that will lead to increase in the premiums on both the sides after you sell this particular option. So that's another disadvantage in case of a short strangle. Now the most important point that we have discussed is never to get too attached to payoff graph and don't lose sight of the underlying chart. Common pitfall that I have observed with most of the non-directional strategy players are that they try to fixate their gaze within this particular obstrat. They totally work with this one. They are trying to extend this particular green graph by this way. Let's say the market is moving on this side, they will try to enhance this by shifting the positions. They will try to enhance, and let's say the market is going on the south, on the downside, then they will try to extend this particular green on that side. But the idea is, this is just a payoff graph. You should actually have some serious rules basis your charts. So let's say if this is your initial breakout zones. So let's say if this gets taken out, then that's where you will try to roll up your profitable legs and roll away your losing leg only if it hits 2x. The moment this gets breached, we are going to totally exit the losing legs. That's the idea, and that's what you should plan. The moment you get into adjusting this kind of a payoff, you're totally focusing on what's happening on the charts, and this might lead to something much more dangerous while this strategy looks simpler. So always remember never to lose focus or never to lose sight of the chart. So chart will tell you everything, and remember why you have initiated. Write it down the moment you have initiated a triangle, why you have initiated, and what are your break-even points on the charts, rather than working totally on the obstra, being dependent totally on the obstra or sensible or any other builder strategy. So remember that the moment you do that, you will end up into a serious mess. And now one of the most important topic that we are going to talk about this particular short strangle is when to initiate a short strangle. I'll just give you a few examples. Let's go to the daily chart. So let's see what has happened here. This was the big fall due to the election time, and markets quickly recovered. So both sellers made money, buyers made money. Now whenever that happens typically, and the range of the candle was quite huge, so market needs some time to digest this both up move and the down move. So market will try to go sideways for a while. So that is where you can make use of this particular strategy. Now other thing is, let's say on an expiry, how you can make use of this particular strategy. Let's assume this was an expiry or a 0 DT. So the previous day candle range was this much, okay, and the market closes somewhere here, and suddenly the market opens with a big gap up. In that case, now the previous day the candle range was so huge, one can expect market to make an inside bar. That's when you can actually try to play a short strangle. I'll give you further more examples for short strangle. Again, this one is a long range candle, and market closes here because of the global handover or something. We open with a huge gap up. You can again see the market made an inside bar. Again, you can play a short strangle in this kind of a range. So the previous day candle range has to be very huge, plus there should be a if let's say if this is a green candle, then there should be a gap, then we can play for sideways or a triangle. Let's say if it is a big red day and if it opens gap up, then again we can play for a sideways. So in green it should be a gap down, and in red it should be a gap up. So that's where you can actually play for triangles, or as I mentioned, there should be a huge this kind of a shakeout and then a huge recovery. Then markets would take some time digest this particular fall and the rise, and that's where you can deploy strangles. I hope you have learned something new about strangles, when to deploy them, when to adjust them, how to adjust them. And the idea is not for you guys to go out and explore it using your full capital. One can definitely go and first backtest this particular strategy. You can actually go and check on the charts also when it has worked, when not it has worked. There are so many tools these days to backtest your strategies, so first go and do that. And whatever new things you are trying, especially in the learning stage, don't go beyond a single lot. Now remember one important thing: for one single lot of a strangle, in case of Bank Nifty, you'll roughly require 1 lakh rupees of margin. So remember that, and always trade with the stop loss. Never go berserk with your account. Remember, all these strategies are fancy, looks good. I mean, looking at the max profit and everything looks very mouth watering. It will entice you, but remember, your account risk management is only with you. That no one will show you. None of these particular websites are going to tell you. So remember, you have to be very strict with your risk management, and please adhere to your risk management. That's the only way to grow. Respect risk no matter what. That's about it for this particular video. And if you have liked this particular video, please do like and share this particular video with lot many others, and please do help us in achieving this 15k subscribers soon. Other than, I'll see you soon with something more interesting educational video in the next week. Till then, bye bye and take care.